Well, we are standing by awaiting a House committee vote on the Consumer Financial Protection Agency. Here to explain how lawmakers intend to protect consumers against abuses in credit card and mortgage lending, among other abuses, we're joined by Kathleen Keest. She's senior policy counsel at the Center for Responsible Lending, and she testified before Congress on this very issue of consumer financial regulation back in June. Good morning to you, Kathleen. Thank you so much for joining us. Do you think this Consumer Protection Agency is a done deal at this point?
Well, I think the bill is going to pass to create the new agency. The question will remain as to whether or not it will be weakened on its way through. We certainly hope it's going to come through as strong as it needs to be to make sure that we don't have the same kind of crisis happen again that we've just seen.
Well, I guess the key question is just where the power is going, who the power is going to lie with here in terms of the state's roles in regulating credit card and mortgage concerns here. Well, what's your thought?
Well, I think one of the things that we hope to do is make sure that at the federal level, what we have is a single agency who, for the first time in our history, will have as its sole mission the responsibility to protect consumers. But we believe that that Washington should not be the center for everything, and that states should have the power to resolve their own issues as they arise. But that what will happen with this agency is that they should be able to set the baseline floor, to set the fair rules of the game for everybody, and then let the states deal with local problems as they arise.
So is this a recognition, Kathleen, here of government failure in protection of consumers in the first place from the financial crisis?
Well, we really know that the system we've had didn't work. That's pretty unarguable. And part of there are three reasons for that. One is that at the federal level, the responsibility was scattered among a lot of different agencies. The result was that there were gaps, there were inefficiencies, there were inconsistencies. None of those agencies had the consumer protection as their single mission, and we had this rather bizarre system where banks could even choose their own regulators. And the result was gaps, inconsistencies. It was a race to the bottom as some of the regulatory agencies were kind of competing to become the favored lender. So we had this race to the bottom, and hit the bottom we did, as we all know now, to our regret. So those three problems are what this agency at the federal level is designed to do: have a single agency that sets the rules of the game for everybody playing the game. It has the consumer protection as its single focus, no divided loyalties, no conflict of interest.
But why would it work this time around? Why would this centrality of that bureaucracy make this work? And how would there not be a spillover in increased prices for consumers as you lay in the need to, educate regulators state by state on these different standards?
Well, with respect to your first question about why it would work, the getting rid of the regulatory competition and getting rid of the charter shopping that we called it, the regulator shopping, I think would help it. As long as you've got an agency whose primary job and only job is to make sure that the rules of the marketplace are fair for everybody, you don't have that race to the bottom, and I think that's why it would help better. In terms of the arguments about the increased costs, I've been doing this for well nigh 40 years now, and every single time we hear any effort to do any consumer protection, it's always going to, the argument against it is always it's going to increase costs and reduce access to credit. But what we've found now, and I think the evidence is just unarguable, that what has happened is that the cost to consumers and the has been worse with the system that we've had, and the impeded access to credit. Of course, it's the lack of regulation that has constricted the credit markets to a degree we have not seen in our lifetime. So I think that is the same horror story they always bring, but there's no evidence to support that.
All right. Thank you so much, Kathleen Keest from the Center for Responsible Lending. Thank you so much for joining us and for sharing your insight.